For the next hour, you'll be leaving the Show Me state and entering the Show Me the Money state. So stop what you're doing, grab a pen, and get ready to learn. Jake Floyd of Floyd Financial Group will be your guide for straight talk and honest answers about living the life you deserve in retirement. So prepare to be empowered. Now, here are your Show Me the Money hosts, Jake Floyd and Jeff Shade.
Good morning and welcome to Show Me the Money with Randy and Jake Floyd, the radio show that gives you the straight talk and honest answers you need to help you reach your wealth management and retirement goals through smart investing and careful planning. My name is Jeff Shade. I'm just here to ask the questions, but of course the words of wisdom and solid advice, they come from Jake Floyd of Floyd Financial Group. Jake, how you doing this fine Saturday morning?
I'm doing great, Jeff. Thanks for asking.
You're certainly welcome. I hope everybody else is having a great Saturday morning. Of course, we're glad to be with you here in the radio talking about your fiscal fitness, your financial education, and boy, have we got a great show for you. A lot is going on this week. But Jake, Randy, your dad has escaped all the madness. He's gone on vacation up to Alaska. I've seen some pictures. He's catching some pretty big fish up there.
Yeah, he's doing really good. He's pretty remote up there. They had to take a little puddle jumper up to where he's at, a little single-engine vehicle. So where he's at, there's no roads to get there. Yeah. You have to fly in. And so if you've been to Alaska before, there's quite a few places like that. But I have never been to a place like that. Sounds a little scary to me.
Sounds like a lot of fun. I saw a picture, too, of your mom, and she's also holding, I believe that's salmon that they're fishing for, right?
Yes, salmon. So this time of year, salmon are starting to run. They're a little bit early getting there, so it's not quite as many fish as what they were kind of hoping for, but they're still having a good time. And so I see a lot of big smiles. I saw a big bear. They sent me a picture of a bear up there,
I saw
which
that
is
too. Grizzly.
Apparently there's 8 or 9 bears that go through the camp every night and all that. And,
wow.
You know, they're licking the grills and all kinds of things. I'm like, man, I think I'll stay here and fish for largemouth bass.
Yeah, I mean, I don't want to tangle with a grizzly bear, pretty much any bear, but, you know, your dad's my hero. Here he is at the age when a lot of people begin to slow down, but he's just getting started here with his exercise and with his travels across the country. I know that he visited every, or at least as many national parks as he could. Now he's up fishing in Alaska, so more power to him and your mom having a great time. Anyway, we're not here to talk about Randy's fishing trip. We're here to talk about what's going on in the market and the economy. We're going to try to break it all down for you. Well, we're going to save a lot of the market and the economy for the second and third segments, but let's start off with Kamala Harris's pick last Monday for vice president. Who's that going to be and where's he from?
Yeah, so Mr. Walz is the current governor of Minnesota, and he's pretty progressive in policy, but he's obviously white. He's a gun owner, you know, so it kind of helps round out her more radical things. You know, they were looking at Mr. Shapiro, which, you know, he's Jewish, and that was causing them all kinds of problems because of her pro-Palestinian, yet they don't want to step on the toes of the woke left, I guess is what she's trying not to do. And they couldn't figure out a way to get around the fact that he's Jewish and not step on the left's toes, but also still be pro-Israel. And so I think they just scrapped that plan altogether.
So with Tim Walz being the vice presidential pick, it's going to be Kamala Walz. Do you think that this helps her chance of becoming president? Do you think that it hurts it, or do you think it just doesn't make any difference at all?
I think there's probably a few moderate Democrats that might vote for her that wouldn't have otherwise based on that pick, but I think by and large it's just going to be very, the memes are going to be everywhere. You know, Harris doesn't build the walls. You know, that's Trump's job or whatever.
Yeah,
you know,
right,
I can just see it already. You know, we'll see how it goes. I think that, in my opinion, in a fair election, I don't think she can win, but we'll see if we have one of those or not. We'll go down that road when we get there.
Do you have a different investment strategy on the side if one wins versus the other one?
Absolutely. The implications of each different president getting in there are really quite different. The main thing that would be different is Trump, as we talked about last week, Trump would drill for oil, which would bring oil prices down. And so that would, you know, bring inflation down, and we'll talk about this a little bit more in a future segment. But if we ended up with Harris, oil prices would likely go up, and conflicts would continue, which would make oil prices go even higher. And so obviously, if you're an oil company selling oil, you want prices to go up. If you're an oil company selling oil and prices go down, your margins get hit. And so if Trump gets in, even though he will let oil companies drill, we probably don't want to own oil companies because as prices come down, their margins come down. They're just less profitable. And so that's one example. But yes, I definitely have quite a list of things that I would do differently under a Harris administration versus a Trump administration.
Well, I know that tax planning is an important part of a financial plan. Do you have a different tax plan or a different strategy if one is elected versus the other?
Absolutely. And a lot of that's going to be dependent on, who you are, where you're at in your retirement cycle, how much income you make, things like that. Because I think the Harris administration would hit taxes pretty hard on people making higher incomes. Trump has said that he would like to extend current tax cuts or maybe even go in with just simply a 2-bracket system, a 15% bracket, a 30% bracket, and leave deductions in place and that kind of thing, which would be a huge tax cut. But, we'll just have to see. We'll have to see what happens. It's pretty early to tell as far as a tax situation, just because even if what they want to have happen, is different than what they can get through Congress.
Well, I know that the 2017 Tax Cuts and Jobs Act is going to be expiring at the end of 2025. Is it possible that that could be extended, and is it a good idea, do you think, to extend it in its current form, considering the situation that we're in right now with the market and the economy? I mean, it's 2024, not 2016.
Yes and yes.
Okay.
No, just kidding. So I think that likely he would try to extend it. It'll be easier for him to extend that than it will be to put in a new plan. I'm sure there'll be some new provisions and things like that. They'll probably adjust where the death tax kicks in and things like that. But yeah, I think that will be the baseline, is that he'll try to extend those, maybe broaden them slightly. Maybe an incentive to have children in this country could be interesting out of a Republican president, where you get tax incentives to have more kids. By and large, the left are not having kids. They don't value traditional, values in this country of, having kids, having a family, all those types of things. And so somehow incentivizing that, I think, might be on the table in a way that maybe it hasn't been before.
Well, we've got about 3 months left to go before the election. The best is yet to come, so we're going to see what happens, but it should be interesting. Talking with Jake Floyd here of Floyd Financial Group, talking about the market and the economy. And, of course, we're going to dive into what happened last Monday here in our second and third segments. Dollar versus yen correction. That's a headline that I saw here recently. Can you break that down for us, Jake?
Basically, what happened is this trade that's been going on in some form or fashion since 1990, really, when the Nikkei spiked to 40,000. Shortly after that, it crashed, and the Japanese began the first rounds of what we know now as quantitative easing, where they printed money to artificially lower interest rates. And so that creates some very attractive but very technical opportunities to use Forex, foreign exchange, to leverage dollars to yen and then buy stocks with it. And that's what really was unwinding on Monday. That was why it was so violent. If you're watching world markets, even though ours was pretty far down, the Japanese market was down 12% on the day. That whole situation has a lot of implications that we're going to talk about here in this next segment.
On a regular basis, Jake, do you pay much attention to foreign markets insofar as investments go for our listeners right here in Springfield, Missouri on average?
Absolutely. I'm always watching what's going on around the world. However, I will tell you that if you look at history over any decent length of time, the United States market tends to dominate other markets and tends to outperform from a risk-adjusted standpoint. And so, I like the United States. If you've listened to this show before, you'll know that I love this country, and I think this is the dog that wags the tail. However, there are situations where I would invest internationally. It's just not my baseline go-to. But yes, I am always watching around the world and watching, geopolitical movements, even for our market, but even in the potential of, investing overseas.
We talk a lot on this program about tech, and we'll be talking about tech stocks and so forth. But I also read a headline that said Google has been found guilty of being a monopoly. Is that true?
I think Google has been a monopoly for like 2 decades, in my opinion. But yeah, the FTC finally got them and said that, hey, and a lot of people don't know this, so let me explain this for a second. So Google right now, I think the last number was $27 billion is what they pay Apple to be the default search engine on an iPhone. So the iPhone is very dominant. It's the most used phone out there. Apple takes in $27 billion in just pure profit from Google for that privilege. So that is the textbook definition of anti-competitive behavior, right? To rope Apple into not being allowed to use other search engines and things like that. It's less about the money than it is the lack of competition. I have actually mentioned that on the show before. I thought it was interesting that they ruled in favor of that because I really didn't think they would. Because you have to understand that a lot of the politicians are in place there the way they are because Google and Microsoft and Apple donated to their super PACs to get them there. So a lot of times they tend to look the other way. But again, I think it's a good thing. I think anti-competitive behavior is not what this country was founded on. I don't want to have too much regulation, but I think it's okay to have these huge woke corporations get checked every once in a while.
Well, I think that Googling something has become part of the American lexicon. I don't Safari it. I don't, use another browser necessarily. Google says the reason so many people use it is because it's the best search engine. So them being found guilty of this charge of being a monopoly, what does that mean for Google? What does it mean for us? Does it really mean anything?
Yeah, Jeff, so I don't know that they have pushed down exactly all the things that they're going to have to do, other than I'm sure they're going to get fined. They're going to put some blocks in place that's going to disallow what they're doing. So it sounds like to me that Google is going to have a lot more profit and Apple is going to have a big chunk of profit taken away from them. And I think the long-term ramification of that is, there may be some other search engines that pop up. If you've ever used Bing, in my opinion, it is not as good a search engine as Google or others. That's the unfortunate truth, is Google is a better search engine, but a lot of that's because it has a larger sample size of things to go through because so many more people use it. So if we get the monopoly broken up there, we might see some other search engines come in. And, I think any other company would probably be good from a geopolitical standpoint because Google's about as far to the left as it gets.
We're talking with Jake Floyd, Floyd Financial Group. We're talking about current events, and we have covered a lot of things here on the program. If this commentary does resonate with you and you want to get in and sit down with Jake here at Floyd Financial Group, talk about your individual situation, your goal towards getting to a confident retirement, we're offering an opportunity to do that right now this weekend by calling 417-889-7233 and requesting your Floyd Financial Group review. It's not going to cost you a dime, and there's no obligation, and of course, never is there any judgment. So make that call this weekend, 417-889-7233. Phone lines are open right now. All you've got to do is leave your name and your telephone number. Ashley will call you back next week and set up that appointment for you. Again, no cost, no obligation, no judgment. Make that call. Get the help you need. 417-889-7233. You can also find out more about us online at floydfinancialgroup.com. Time for a break, Jake. When we come back, we'll dive into everything that happened this week that started on Monday with Wall Street. Little nail-biting time. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
Ready for another helping of some more real money talk? Thought so. Now, here's another serving of Show Me the Money with your hosts, Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment we're going to be talking about Japan, the carry trade, and the yen. Oh my.
Jake, that's rather interesting, the introduction there. Give us a Japanese history lesson on why this applies to what we're talking about.
Yeah, so as I mentioned earlier, at the end of the 80s, the early 90s, the Nikkei and the Japanese market in general was very dominant, and they reached kind of their tech bubble in about 1990. And as things unwound, they began to artificially depress interest rates in a way that had never been done before. So they lower interest rates to zero, and then they started printing money over the top of that. And without getting in the weeds on that, they did that through issuing bonds and then holding them on their balance sheet and thereby printing money. That part's not as important, but that may sound familiar because that's what we started doing in 2010 on the back of the financial crisis to stimulate the economy, trying desperately to get to 2% inflation over the next decade, which is kind of laughable now after the inflation that we've had recently. But I digress. So in Japan, because of this anomaly, something called a carry trade started happening. And a carry trade is not limited just to Japan, but the idea of using foreign exchange to leverage dollars to another currency, in this case the yen, and then using the yen to purchase assets in a way, again, that's leveraged and is risky, but ultimately has large rewards if the market's headed your way. So that started to unwind over the last couple of days, really, but prior to Monday, so last Thursday, Friday, and then it kind of came to a head on Monday. The Japanese stock market was down 12+% that day. Basically what was happening is these big hedge funds, large money managers, and other people who had been leveraging this money kind of got caught with their pants down, if you will, meaning the yen had been getting weaker and weaker and weaker and weaker against the dollar for a very long time. And so they finally decided they can't let it get any weaker. And so they started raising interest rates. And so all the people that had done this carry trade, they started to get margin calls. So a margin call is where you don't have enough money to meet the positions, the margin requirements inside your account. And again, I realize this is a little technical, but the long and the short is they were gambling and they got caught and they were forced to unwind and liquidate highly appreciated positions in stocks like NVIDIA and Apple and Microsoft. And that's why we saw this really vicious kind of tech sell-off at the beginning of last week. But that's also why it was relatively temporary in nature, is because that all came to a head all at once. And so we saw a once-in-a-lifetime spike of something called the VIX, which we'll get into here in a minute, more affectionately known as the fear gauge, but it basically measures volatility. And it went up to 65 in the morning of Monday, which is, there's only been 2 times ever that it was higher than that. One was during the pandemic in 2020, and the other was the financial crisis. And other than that, that was the 3rd highest reading ever.
So, Jake, how does this situation in Japan correlate to what's happening to us now here in America?
You don't need to be super worried about Japan, and the takeaway from this is just that this is kind of a one-off issue. I really think a lot of the selling would have been over had we not had this Japan situation unwind over the weekend based on Japanese political decisions. What you need to know is that part of it is now kind of liquidated and has unwound and is probably over. Now, that does not mean that there can't be something else. In fact, the lesson we really want to take away from this is you never know when the unknown is going to come and bite you. And so sometimes I have people that are like, hey, I want to have 100% guarantee that something's going to happen. And this is why there is never a 100% guarantee. You cannot guarantee that markets are going to be safe. Even if everything looks good and is set up right from a technical and fundamental standpoint, there's always these kind of black swan events that can jump out and grab you. Just because this one's over doesn't mean there's not more to come. Doesn't mean we don't have an election coming up, a highly contested election, right? And so I'm not saying that it's all clear. I'm simply saying that piece of it is probably done for the moment.
So let's talk about what's happening in this country on Monday, particularly at one point the Dow Jones Industrial Average was down 1,200 points in a day when the equity markets tumbled across the globe. It closed down 1,034 points or 2.6%. Is it nail-biting time on Wall Street? And, have we stayed at the party too long, do you think?
Jeff, I really don't think so. I really think that this is just a normal correction. It's just that we have very short memories because it's been about 10 months since we had a real correction. People tend to have short memories about these things because all they know is the market's going up and they're up a lot. And then when it starts to come back down for the first time in a while, everybody's kind of panicking. But this is the way the market works. The market goes up, but the market also goes down. I don't see anything at this point about this correction that is unruly or problematic. Again, we had a little bit of panic during Monday morning, but that was simply based on forced selling from these margin calls. And so now that that's done, I don't see any big issue. Now, one of the other things as we're going through this that we should talk about is Goolsbee, who is the vice president of the Fed, came out that morning at like 6 a.m. and he said, hey, everybody relax. If the economy starts to break, we'll fix it. I mean, those were his words. He said, we'll fix it. So what does he mean by that? What he means is we'll gut interest rates and print money like there's no tomorrow if we have any problems. Well, that's not necessarily a good thing because we've already printed a lot of money. What it is if our economy starts to actually falter, meaning we have rise in unemployment, less jobs available, that type of thing, the Fed will not hesitate to step in. And this Fed is as dovish a Fed, meaning as willing to print money and lower interest rates as any Fed in history. I believe him. I think they will absolutely step in if they're needed, including a potential emergency rate cut. I don't know if that's in the cards, but certainly would not shock me if Powell did it. He already did it in 2020. In fact, I think over the last 30 years, there's been only 9 emergency rate cuts, and Powell did one of them. 2 of them were during the financial crisis and then a few other times. Yeah, I really think that we're still in a pretty good spot here. That does not mean that we will not have volatility going into the election, because I do think we will. I think regardless of election outcome, somebody's going to be in Wall Street wanting the place to burn. It's just which side they're from that will change based on, who gets elected. And so it is time to be maybe a little bit cautious and prudent. I don't think we should just go all in here. But I also don't think we should be out of this market here, because it may surprise us to the upside given the abundance of negativity. As I've talked about before on this show, when everybody is negative, that's usually when you want to be invested. And when everybody's too positive is when you want to watch out. Things got a little bit too positive in early July, then things started to pour out a little bit. But now that things are down, there's plenty of people, saying, hey, it's all going to fall apart. We were talking before the show, you and I, talking about some articles that you read that people are saying, oh, it's all over, the whole thing's going down. And honestly, that's music to my ears as an investor, right? Because that means that we're getting closer to the bottom of this temporary move.
We're talking with Jake Floyd of Floyd Financial Group. Our phone number, 417-889-7233. If you want to get in and sit down with Jake, have a private conversation about how all this affects your retirement, 417-889-7233. You piqued my interest, Jake, with rate cut talk. I love Wharton professor Jeremy Siegel. I saw him on a broadcast at the beginning of the week. He's pressing the Fed to issue an emergency 75 basis point rate cut, followed by another 75 basis point rate cut at their September policy meeting. Do you think that we're going to have any such thing? That seems to be a bit much.
Mr. Siegel was also a massive critic of the Fed on the way up and said that they were not raising fast enough and that they needed to get it over with. It kind of depends on what your goal is as far as the Fed is concerned. If you're one of these people that wants the Fed to help out markets and make things go extra smooth, but maybe at the cost of a little bit of inflation, then yeah, he's probably right. But if your goal is to have the Fed actually act in the manner it's supposed to act, which is price stability and maximum employment, I think it's hard to criticize what the Fed has done at this point. A lot of people were very critical of the Fed in 21 and 22. And with the benefit of hindsight, we could say, yeah, they probably should have started raising rates a little bit sooner. We didn't have that benefit of hindsight at that point. I think they raised aggressively and through a lot of turmoil and really got the job done with minimal casualties, if you will. And I was critical of him a couple of years ago, saying that there's zero chance of a soft landing, although I would retract that statement now. I think there is a chance of a soft landing. I think it's really going to come down to who gets elected as president, probably, whether or not they can land this plane safely and with as little turbulence as possible. But things have changed so much in the last 4 or 5 weeks. Another 4 or 5 weeks from now, the whole landscape could change a lot too.
Let's say that Powell comes out before September and does this emergency rate cut. Does the market rip, or do you think it stays the same?
I think the market would go insane to the upside if he came out and said, hey, here's a 50. Especially if he did 75, I don't know. 75 might be too much, because if he does 75, people are going to be like, should I be panicking right now? Because that seems like a lot. But if he just came out and said, that last jobs report gives us a little bit of pause, so with an abundance of caution, we're going to do a 50 basis point rate cut, and then we'll see you again in September and look at it. I think if they did that, I think the market would breathe a huge sigh of relief, and we'd probably be back to all-time highs in the near future. But I also think that's precisely the reason why that's not very likely, is because that works against the progress they've made on inflation. I would say if we had, 3 or 4 Mondays back-to-back of last week, then we might be in line for an emergency rate cut. But I don't think the amount of volatility we've seen so far is enough, because we're really just talking about, a normal-ish correction at this point of about 10%.
Well, I don't see us having a 75 basis point rate cut, anytime in the future, and in the near future, of course, another rate cut. What do you think is realistic as far as the rate cuts go if we do have an emergency rate cut and throughout the rest of the year?
When it comes to rate cuts, I think anytime they do an emergency cut, there has to be a real emergency. So I don't think we're going to have that. And again, I could be wrong, but I don't think we're going to have that. I think what's going to happen is in September, they're going to cut 25 basis points, but they're going to put in the notes that they thought about cutting 50. That way people are like, okay, they're paying attention. They're willing to go more if they need to. but here's 25. And then I think we're going to see another 25 in November. I think we're going to see another 25 in December. And so that will put us well on the path. Banks are going to be clinching up on paying interest, but they're going to be willing to loan out more money. There's a lot of positives from lowering interest rates. And in the next segment, we're going to talk about some more of that, about housing and all that kind of thing. But rate policy is incredibly powerful and incredibly important. There's a lot of people that don't understand that, Jay Powell holds the entire economic world in the palm of his hand. The president is not as powerful as Jay Powell, other than the fact that the president can fire him, but he can, with a few words at the end of his pen and a few things he says at a press conference, can totally shape global markets. That's a lot of power.
Yeah, and it reminds me of that song. The lyric is, he's got the whole wide world in his hands, and I think it is true when it comes to Fed Chair Powell. We're talking with Jake Floyd, Floyd Financial Group. Again, we've had a great conversation here today about what's been happening in the market and the economy. Remember, we're a podcast. If you've missed any part of the program, go to wherever you get your podcast. You can Google it if you're not afraid of, dealing with a monopoly there. You can Google Show Me the Money with Randy and Jake Floyd. You'll find this show and many of our past shows so you can stay on top of your journey towards a confident retirement. Jake, we're going to take a break here. When we come back, we'll continue this conversation and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
We're back with your financial catch of the day, and it's a big one. Here's more Show Me the Money Radio with your hosts, Jake Floyd and Jeff Shane.
Welcome back to Show Me the Money. I'm Jake Floyd, and in this segment, we're going to continue talking about interest rates, the Fed, and emergency rate cuts, ?
Yeah, and we'll be talking about that more in just a moment, along with mortgage interest rates, too. They're coming down really quite rapidly, but let's talk about those 4 important words. Don't fight the Fed. Can you explain that, how that applies to this situation?
So the Fed is almost certainly done raising interest rates. We're talking about cuts. We're talking about how many cuts. So the possibility of a rate raise is still out there, but it's probably well under a 1% chance at this point. So if we know that the Fed is either going to stay the same or start lowering interest rates, anytime the Fed lowers interest rates, it's stimulative to the economy and to the stock market and to the housing market and asset prices in general. And so the saying on Wall Street, don't fight the Fed, that means if the Fed is easing their policy, it's very likely to inflate asset prices like the stock market and housing and those things. So don't be out of the market and don't be pessimistic when the market is running with the Fed and their rate cuts. That's really what that means.
Okay, so are you getting feedback from your clients about this situation, about the Fed rate cuts? Have you had calls about that? Are people worried about what's going to be happening here this fall?
I don't think people are specifically worried about the cuts. I think people were definitely a little worried on Monday when things were were kind of falling apart. But I think that's why I wanted to talk about it here on the radio and have people understand what happened. And if you missed that segment, you can go out to our website at floydfinancialgroup.com, and this will be out there,
right?
Where you can go back. But basically, 15 or 20 minutes prior to this, we talked a lot about the Bank of Japan and that kind of thing. But I think it's important to understand where the problems are coming from, especially when you're in retirement. You understanding where the problems are helps you realize that maybe we don't need to worry so much, right? And it depends on, if we're on the verge of a great recession or something like that, like we were in 2008, that would be different. This is just normal market fluctuation at this point, in my opinion. When it comes to the Fed, though, it's very likely over the next little bit here, we're going to see the Fed lower interest rates potentially a lot, depending on who gets elected and a few other things. But we may see interest rates go back to zero. We may see the Fed start quantitative easing again. And if we do, we'll see interest rates come way back down. And so if interest rates come down a lot, where you can do a 4 or 5% 30-year mortgage again, the housing market's going to ignite. It's going to be on fire. People are going to be wanting to trade and refi and move houses and all that kind of thing. And all that drives commerce. And so I think it's going to be very difficult to have a prolonged recession in that environment, especially because, the earnings on the S&P 500, which ultimately determines the valuation of those stocks, are really pretty good. They're making lots of money. And as long as these companies are making lots of money, it's going to be hard for stocks to go down meaningfully. And so interest rates coming down is a good thing, even though it may not feel good if you're a saver or if you have a lot of money in the bank. But for economics and for overall asset prices, interest rates coming back down is good.
Well, as we said earlier in the program here about rate cuts happening towards the end of this year, we're expecting 25 basis points at a time. We could have several of those towards the end of the year here, as you said. For savers, maybe not good news. Where do you think things are going to be going here after, the calendar turns 24 to 25 insofar as further rate cuts? And I know we don't have a crystal ball, but, where do you see things standing the summer of 25?
Yeah, so I really am kind of in the camp that interest rates come down no matter what. So if we get Harris in there, she's going to continue spending money. The market will like that. But her policies, in my opinion, will lead to a situation where we will have at least a mild recession. If we have that, then the Fed will be forced to cut interest rates. Interest rates come down probably all the way to zero or close to it. And so that's one scenario. If we end up with Trump, I think that Trump will drill for oil. If Trump drills for oil, oil prices come down. If oil prices come down, that controls the shipping and manufacturing of almost everything on the planet. And so if that input price comes down 60% or something like that, then prices are actually going to come down, which will then allow rates. We will have defeated inflation, right? And then now we got to be worried about deflation. And so we will lower interest rates to stimulate the economy and stimulate markets. So I think either way, interest rates come down. The question is how much, how fast, and what kind of economy we have while interest rates are down.
So for the average investor, the average saver, what does this mean to us? What should we be looking forward to or not looking forward to when the calendar turns 2025?
It means that the days of 5% CDs are limited. Mm-hmm. And so if you have been enjoying the 4.5 to 5.5% CDs out there, you need to get ready for a new reality, and we're gonna see interest rates come down probably a lot. And as that happens, banks are not going to want to be caught holding the bag. In fact, if you have CDs renewing, even right now, I think you will see that your rate will come down from where it was on your previous CD. You need to think about where are you going to come up with this income if you're living on that income in retirement. Where are you going to come up with this income that you're not going to have anymore? And so that's one of the places where we can help. We have different ways to do safe, conservative money as well as money in the market. Give us a call and talk to us, and we can talk about how we can hedge our bet a little bit against interest rates coming down too far too fast, where that interest dries up and you don't have any income.
We're talking with Jake Floyd of Floyd Financial Group, and again, our telephone number 417-889-7233. If you'd like to get in and sit down and talk to Jake or Randy when he's in the office about what's happening in the market and the economy and how it applies to your individual situation. So it sounds like that if you've got CDs at 5%, you have a chance to renew them at 5%. Probably a pretty good idea to do that because next year that's not going to be the case. So let's talk about some of these safe money alternatives that you had alluded to that would be sort of like a CD but would not be like a CD. What are we looking at there?
There's a number of different things we can do. The most obvious one out there right now is bonds. Bonds have been awful for a decade. You've taken significant risk and made like 20% cumulatively on bonds over the last 10 years. However, that weakness and bond prices coming down in 2022 presents a unique opportunity because now bond interest rates are high and bond prices are relatively low. And so what will happen is as interest rates come down, not only will you have a higher interest rate on your bond if you were to buy it now, but that bond will appreciate in value if you decide to sell it ahead of time as interest rates come down. And so bonds are in a little bit of a win-win-ish situation right now. Now, nothing's perfect and there's a lot of things that can happen, but bonds look attractive for the first time in nearly 15 years probably. Another idea is you can use fixed annuities, either a CD type like a MYGA fixed annuity, where you can get multi-years of guarantee as of this date. You can still get like 5.75% for 5 to 7 years. Now those rates will come down as interest rates come down, but you can lock in for longer in a MYGA type annuity than you can in a CD. Because if you try to get like a 5-year CD, they're going to pay you like 2 or 3%, not 5%. There's also hybrid type annuities like fixed index annuities, RILAs, and those types of things where we can have the stock market be our engine, but not necessarily put money at risk or put money at risk, but have protections in place. Those are a handful of things that we can look at. Commodities also do well in falling rate environments, depending on the severity of if we have a recession, that kind of thing. But if we're just having falling interest rates because we're having deflation and we're trying to stimulate things, gold should do well. I mean, even things like Bitcoin will do well. And so you're not limited. It's just the guaranteed interest of CDs and money market accounts is going to dry up. And people are just kind of getting used to it right now because they had, we didn't have it for 15 years. And, in 2022, they started giving us our interest back. And so I guess all I would say is just don't get too comfortable with that interest because I think it's going to be heading out pretty soon.
Jake, how do interest rates affect annuity payouts or returns?
Yeah, so if we're talking about, annuitizing an annuity, which I don't usually recommend, but if we did, higher interest rates give us larger payouts of income. However, if we're using a deferred annuity and we don't plan to annuitize, the horsepower is higher while interest rates are high. And so if you're thinking about wanting to lock in interest rates for a little bit longer using different types of tools, now would be a good time to talk about that while interest rates are still relatively high, before all the interest rates really start coming down. And again, if we talk about these things, there's going to be no pressure from my part. I'm just going to try to help educate you on what's out there, and so you can make the best decision possible.
So when people come into you, Jake, and you have these conversations, I think that's very important for people to know is that you're not there to really sell them any one particular product, that really this is just an educational opportunity. You will suggest things, but the choice lies with the client.
Jeff, we're very blessed here. I'm kind of in a situation now where I'm not really needing to take on new clients. And so that puts me in a nice position where I can have conversations with people. And if it makes sense to do some things, then we'll do them. And if it doesn't, that's okay too. And I genuinely mean that. If you come into me and I think you're in good shape, I'll say that too. So yeah, there's no pressure at all. My goal is just to educate and help people make the best decisions possible.
So again, I think you said, I don't need any new clients. You're not saying that I don't want any new clients, that you shouldn't call us. But I think what you're really saying is that we're not here to give you a hard sell on anything because we don't necessarily need the money. The whole focus of Floyd Financial Group, it sounds like, in the office and with this show, is to educate and inform. You're really telling rather than selling.
Exactly, yeah. And again, I also don't want people listening here to feel like they have to call and schedule. If you enjoy listening to this show, then I appreciate you listening. And, we try to offer helpful information to make it worth your time when you listen. We try to make things comedic at times too, to make it a good show to listen to. But, if you do want to have more one-on-one help, I'm here for that as well.
So remember, no questions are off limits at Floyd Financial Group. Don't feel like you can't give them a call. We want you to give us a call this weekend, if you will. 417-889-7233. So many people have said, I've got nobody to turn to for financial advice. Not the case here in Springfield, Missouri. If you want to have a casual conversation, it is a no-tie zone. If you want to ask the honest questions that you need honest answers to, give us a call this weekend and set up that appointment. Our telephone number, 417-889-7233. All you've got to do is leave your name and telephone number. Ashley will call you back during the week and set up that appointment that's convenient for you. No cost, no obligation, and certainly, as always, there is no judgment whatsoever. 417-889-7233. You can also find out more about us online at FloydFinancialGroup.com. That's FloydFinancialGroup.com. Jake, it's time for a break. When we come back here in the final portion of our program today, we're going to be talking about the housing market, how these interest rates affect that. All that and more when our show continues here on 104.1 FM KSGF, where Springfield comes to talk.
People of the Ozarks, step away from the fishing pole and prepare to be shown the money, because we're back with more straight talk and honest answers with Jake Floyd and Jeff Shea.
Welcome back to Show Me the Money. I'm Jake Floyd. In this last segment, we're going to be talking about a little bit more about interest rates, mortgage rates, debt, and refinancing your house.
Okay, and Jake, I've been checking the mortgage interest rates lately. I'm sort of in the market for a home, and it wasn't that long ago that I was seeing, the figure that they plugged in the little calculator online was like 7.3%. Now they're plugging in like 6.5, but you're saying that the interest rate on a 30-year mortgage is actually less than that today if you've got perfect credit.
Yeah, so if you got good credit, 760 or higher, I believe the number right now, or at least a couple of days ago, was 6.34%. It was the average rate. while that still sounds kind of high, that rate was over 8.5% a year ago. And so I think that it's important to understand what's going to happen here as interest rates keep coming down. There's a lot of people already that are kind of foaming at the mouth to refinance their house so they can pay off their 30% interest credit card debt and that kind of thing. But I do think that if you have a little patience, I think you're going to get it lower still. And I think that for the last 25 years, Americans have kind of become addicted to running up the credit card debt, refinancing the house, paying off the credit card debt, and then going again because their house has always been worth enough and they've always had enough liquid enough housing market to do that. But I think that game has been over for a couple of years now, and if it comes back, I think it could be Katie bar the door. This is one of 10 major reasons why I think the markets could be a lot higher a year from now.
Yeah, and Jake, if you've got 30% credit card debt and you keep doing it again and again, I mean, that's the American way. If you are debt-free and you're worried about your own personal situation, you're just weird, as Dave Ramsey says. But in this case, it is good to be weird. So mortgage rates right now around at this program's airing about 6.3%. Do you see them passing through 5% in the coming year? What do you think?
I really do, Jeff. I think we're going to go back there, and we may go even lower. Part of the reason for that, let's zoom out for a minute. So again, if we end up with Kamala, I think we may have some kind of recession at some point that will dictate interest rates coming down. If we end up with Trump, though, we will lower interest rates because we must refinance this $35 trillion worth of debt we have in this country. This is not credit card debt, but the actual debt of the country. We were paying about $300 billion a year in debt service. Now we're paying $1.2 trillion, which is like 75% of the total tax revenue. And so it's just killing us in this country, all this debt. And so it's less about the number of debt and more about what the interest we're paying on it. And we're paying 4 and 5% on a lot of it. And so I think if Donald Trump were to get elected, I think if he thought he could, he would get that deflation rolling by pumping oil, and then use that as an excuse to get interest rates down so that we can refinance the debt. If that happens, I mean, we may get all the way back to zero and then some, So, I mean, we may see, it's conceivable we could see a 3-point-something mortgage again.
Wow.
Now, I'm not saying that's like super likely, but it could be in the cards there. And that's my second reason of 10, that I think that markets could go a lot higher is if we really got interest rates way back down. Again, markets are going to go up a lot. Multiples are going to go up a lot. Housing will go up a lot because everybody will be buying, and their ability to buy will be much greater. They'll be able to do it with this newfound extra wages that they've been earning since the inflation kicked in a few years ago. So, again, there could be a lot of good things that come out of this.
Yeah, I think the average cost of a home in America, I read something the other day, was something like $413,000 these days. And with interest rates as high as they are right now, that excludes a lot of people from becoming homeowners. If the interest rates do come down and we're allowing more people to become homeowners, that really can have a positive effect on the economy. How would that affect the economy if more people were homeowners, paying things like property taxes, etc.?
Yeah, so, home ownership is by and large a good thing for the economy. And people spend money on their house, they fix up their house, they trade houses, all that creates commerce. And I think that when we're looking at the credit card debt too, right? So if people own their house and they're able to refinance and pay off that credit card debt, now they have newfound leverage that they can go buy things again. As they go to TJ Maxx or wherever and start buying things and running up that debt again, that all creates more commerce, which creates pay for workers, more jobs, all those types of things. And so while I'm not saying it's a good thing to go run up debt, I'm just simply saying the cycle of running up debt, paying it off with your house, and then going again is by and large pretty good for the stock market.
Jake, as we get into retirement, many times people look around and they say, I don't need a house this big. I'd like to downsize, or maybe even further, maybe I should just sell the house and rent. Let me ask you this. Do you have to be a homeowner in retirement? Is it ever a good time to just rent, do you think?
So from a simplicity standpoint and a, not having to work around the yard standpoint, absolutely. From an economic standpoint, I think if people are thinking of doing that from an economic standpoint, I think they will not be thinking that very long if they go look at prices.
Right.
Because rents are insane right now. There's places in town here, and I can't believe I'm even saying this, that are for a 1-bedroom, like 1,800 a month.
Wow, that's crazy.
Last time I checked, this wasn't San Francisco, but that kind of feels like it. And so, rents being really high like that really promotes more home ownership, which ultimately is good for the economy and everything. There's nothing wrong with being a landlord and owning rental property and people renting your property. I'm not saying there is. I'm just simply saying that individuals doing well enough to buy houses and fix up their house and that kind of thing churns the economy more and really creates more jobs inadvertently. Home ownership is generally a good thing. That being said, we don't need to be giving people houses. That's a whole nother thing.
Oh yeah.
But people being able to stand on their own 2 feet, get out of mom and dad's basement and buy a house is by and large a good thing.
Yeah, and I remember if you had a pulse or a heartbeat, you could get a mortgage during the housing crisis. We don't want that to happen again. But interest rates of 3% like we had, I've heard of people who have interest rates that are even below 2%. What is going to happen in this market and this economy in the coming year or two in order for mortgage rates to go back to 3%? I mean, that's highly unusual historically.
Yeah, but once you're down there, it's pretty easy to get back there. And the reason for that is, it's not like we're trying to come down from 18% or something. I think that it's pretty even likely, I would say, under a Trump presidency that we will have much lower interest rates because Trump understands debt. He understands that this debt is killing us and he has to refinance it. I think we may even see him engage 50 and 100-year bonds potentially to really kick the can down the road as far as possible. So I don't think interest rates will come all the way down there and stay there for a long time, but I do think they will come down quite a lot. And then at some point, they'll go back up to a more neutral rate, maybe around, and again, this is total speculation at this point, but 2.5% or 3%, something that's not restrictive, but is also not stimulative to the economy, therefore creating inflation.
Talk about the economy and the market, Jake. How important is the housing market to the overall picture?
The housing market is huge and very important. In fact, it's very difficult to overstate the importance of the house, the role that the house plays in the American economy. It's one of the things that makes America America. There's a lot of other cultures that really don't own their own properties the way we do, even developed nations, right? I think it's a very important part of what we do. I think that it's essential to liberty and freedom to be able to own your own house and do so relatively affordably. It doesn't have to be dirt cheap, right? But it doesn't need to be only for multi-gazillionaires. And there's a lot of other developed nations that it kind of is that way, where,
Right.
You got to be mega wealthy to own a house. Otherwise, you're just renting and renting and renting, therefore kind of enriching other people. So I do think it's very important. And I think that it'll be toward the top of Trump's list if he gets in to work on that. I'm not sure that Kamala has ever even had a thought about that, but maybe if she debates at some point whether she has anything to say about that or not.
Well, Jake, we've talked a lot about a lot of things on the program today, not the least of which is what happened last Monday. We've talked about interest rate cuts, possibly. We have talked about so many things. What do you want the listener to take away from today's show? In all, when you figure everything that we have talked about, Jake, what sort of thought do you want our listeners to have going into the rest of this weekend and, going into this presidential cycle and going into 2025?
I think that to any current clients that I have out there listening, I want them to know that I'm paying attention. I understand what's happening out here, and I do not take lightly the responsibility I have to my clients. Anybody that is not a current client, or everybody in general, I would say that time in the market is more important than timing the market, meaning we don't want to be knee-jerk reactionary to every little thing that happens. Otherwise, we're just going to miss out on a lot of gains, right? And so there is a time to be conservative, and there's a time to be aggressive. But by and large, we just need to stay invested and stay calm and that kind of thing. So I think that's where I would leave it for today. I do think that it's likely that it's not going to calm down, really. It doesn't necessarily mean things are going to go down or up or anything, but I do think that it's going to be a news-rich environment over the next 2 or 3 months going into the election. And so we'll just all buckle up and, if you're a Christian, pray for our nation, pray for our leaders, pray for wisdom, and, Other than that, though, I do think that things are better than a lot of people would have you believe, than the media would have you believe. And I find that I am much more optimistic than the average person, even given what I know. I really think there's a good chance of very good things happening in the next 3 to 5 years and even 1 year. And so don't get too doom and gloom because the media says that you should.
And Jake, you and I are on the same page about this. I want our listeners to remember this too. If you're worried about the economy, you're worried about anything in your life, remember the opposite of worry is faith. Jake, we've had a great show today. If our listeners have missed any part of it, we're a podcast. Google Show Me the Money with Randy and Jake Floyd. You'll find it in any number of podcast platforms, along with many of our past shows, so you can stay on top of your journey towards a confident retirement. Jake, we're out of time for this week. I want to thank you for your time, but most importantly, I want to thank our fine listeners here in Springfield for joining us. For Jake Floyd, I'm Jeff Shade reminding you, keep the faith. We'll talk to you again next week with another edition of Show Me the Money right here on 104.1 FM KSGF, where Springfield comes to talk.
The information provided in the preceding program is for educational purposes only and are not intended as investment advice for any individual or entity. All information contained herein believed to be from reliable sources. However, we make no representations as to its completeness or accuracy. The opinions expressed are subject to change without notice and do not constitute financial, legal, or tax advice. Please consult your financial professional before executing any financial strategy. Financial planning offered through Floyd Financial Group, LLC, an investment advisor registered in the state of Missouri.